Yo, it's crypto blood, Detroit flow, screaming from the D, knowing what to show. Indicators are wrong point, OG since 12, invested in trade, living life like a pro. I'm Rucker, Jerry, it's just blood too. Bad motherfucker in a good way, boo. Got my eyes on the charts, ain't no time to sleep. Get that money, gotta keep it creep. This my crypto blood, just the toasters on the line. Stacking my coin, got the market on my mind. Bitcoin, Litecoin, Ethereum too. Cash is king, but I'm looking for a new move. I know the culture of the markets like the streets. Got my finger on the pulse, can't nobody beat. I see the trends, I see the flow. Got my strategy.
Stacking my coin, stacking my coin, stacking my coin, stacking my coin, Bitcoin, Litecoin, Ethereum, cash, Bitcoin, Litecoin, Ethereum, cash, stacking my coin, stacking my coin, stacking my coin, stacking my coin, Bitcoin, Litecoin, Ethereum, cash, Bitcoin, Litecoin.
Do it live. I'll write it and we'll do it live.
Okay. Ready?
Fucking thing sucks. We'll do it live. Okay.
Holy moly! We're doing it live, ladies and gents. Welcome to the show. Hope everyone's doing well out there. Got a couple people in the building. AI Griff in the house. We got Jason Lynn's in the building. What's the word? What's the word, ladies and gents? Man, this is an epic FOMC. Might be the most important one we've had this year. I'm going to be honest with you. This might be the most important FOMC meeting, interest rate decision this year. Drop in the comment section, the chat room right now. What do you think the verdict is going to be? Is he going to pause them draws, or is he going to cut them rates? Let me know. Give me a 1 if he's going to cut. Give me a 0 if he's going to pause. Let me know right now. Let me just make sure my looks like everything is good to go here. All right, my microphone check is looking good. Hit that like button on the way in, ladies and gents. We got people watching over on X right now. About 40 people over on X watching. We got about, I don't know how many people, maybe 70 people watching on YouTube right now. AI Griff said his short turned out ass, but it might go the other way, man. I'm going to be honest with you. We've been killing it with Scalpalytics big time. Just FYI, been rocking it out the park with the Scalpalytics Pro. But I highly advise to maybe sit on the sidelines with this FOMC. It's going to get volatile. It's going to, I mean, if you look right now, let me just bring this up. You look right now at the Scalpalytics Pro for Bitcoin and Ethereum. We've been going back and forth, even though we had a nice trade long today. Started in the EU zone. Nice trade long there on Ethereum right there, ladies and gentlemen. We took home the money on that one. Starting to come back a little bit, but we entered the long at 7, almost 8 o'clock this morning, before the U.S. trading zone. And yeah, looking quite good with that trade. Now, the Bitcoin trade, we just toggled back and forth. We're short now. We're short now on Bitcoin. And am I logged in? I'm not logged in. God darn it. Let me log in really quickly to my BYDFi account so we can try to make this short trade. I'm going to try to enter this short trade, ladies and gentlemen, live. You guys know how we do over here. We trade live and direct. Live and direct. Might need, dang, I need my email and my Google Auth. So let me get that really quickly. As you see, we're leading up to the rate decision in about 2 minutes. So we got to get on it, ladies and gents. We got to get on it. I might miss this trade, to be honest with you. Might miss this trade. Let me see if I can log in. Oh, I need the email. as I tell you guys not to trade, I'm trying to get into a trade. Not a good look. But we got to do it live, ladies and gents. We got to do it live. So let me just get logged into BYD5 right now. Link in the description below for this awesome exchange. All right. Let me just log in really quickly. All right, I'm locked and loaded. Let's get the account up and loaded here. Let's see if we can get into this trade, this short trade on Bitcoin. We got 1 minute, ladies and gents. 1 minute. I'm trying to get into this trade so I can get wrecked. So I can get wrecked real quick. Let's get into this trade. I'm going short. I'm ready to change my direction if need be. But we're short right now. Let's see what they have to say over on CNBC real quick.
Inflation is rising. The economy is fragmented into that K-shape we all know about now. And let's not forget, we have a once in 100-year trade shock. How is the Fed going to explain all of this to us? And how are they going to set us up for 2026 in an economy that is decreasingly interest rate sensitive and yet still has its firm eyes on what Powell or Powell's predecessor does next?
Would you consider David Kelly today to be what they would say is a hawkish cut, but with cautious language?
It's kind of like when parents give a kid, okay, you can have one more cookie, but this is the last cookie.
It never works
until the next one.
No, well, exactly. But I think there's going to be it's going to be a cut. We could get multiple dissents here, and I think they're going to really push it out and say, don't expect another near-term cut.
Jim, I don't want to look too far ahead of today because it does matter. 90% chance of a Fed rate cut today. Looking at the CME Fed Watch tool, you got about a 25.
I'm getting wrecked. Not too bad, though. I didn't put that much on the table. Only down 130 bucks. I'm going to have to. Let's see if okay. Wait a minute. Coming back down.
Messaging for the Fed. The Fed has to be careful, though, right? It doesn't want to walk into a policy mistake by being either too hawkish or too dovish, because the path of least resistance right now is towards higher bond yields, which is not necessarily effective or a good thing for markets. So if the labor data continues to weaken, if it softens further, then I think January is very much on the table. If it doesn't, then we're going to kick the can down the road.
Yeah, we're going to find out here in about 15 seconds. Like we said, it is a mixed trade. You got the NASDAQ slightly down, the Dow slightly higher, the 10-year yield right around 4.16%. Let's go now to Steve Leishman on the Fed's decision on interest rates. Steve.
That should be a short move.
The Federal Reserve reducing interest rates by an expected. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Smith, his second dissent in a row. Also, another dissent for a 50 basis point cut from new Fed governor on loan from the administration, Stephen Myron. To recap, the vote was 9 for cutting a quarter, 2 against cutting, 1 for cutting 50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up a half a point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace, job gains have slowed, and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated, economic uncertainty also elevated. Back to the Fed outlook and the dot plot real quickly here. Only 2 dissents, but 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft dissent in that regard, you can call it. 7 want no change at all for next year. 11 only want 1 cut next year. 1 person, and we can imagine who that is, Stephen Myron, just guessing here, wants rates down to 2.12% next year, or 150 basis points lower. And that is the statement and the outlook for rate cuts and the balance sheet. Mr. Sullivan.
Quickly, sir, you said buying bills maybe sooner than the market expected. This is not QE. I do not dare call it that. But is this like the son of QE, quantitative easing light?
You know, Brian, people are going to take off on this, and I don't want to stop the craziness that'll happen in social media and on the interweb. The Fed will say this is maintenance of its balance sheet at a level of GDP of where it was. Some people, however, will call it QE light. Some people will call it son of QE. I believe the Fed will say this is neither, that this is simply maintaining the balance sheet at what they call the ample level of reserves, and that will cause them or prompt them to begin buying $40 billion of bills. It looks like 3 years. They also may go out a little bit into the bond market as well, but they want to stick to the short end of $40 billion a month until about April, when they say there'll be a sharp decline in there. And Brian, call it what you will.
Let's see what Rick Santelli calls it. Steve, stay right there as you can.
All right, there you go, guys. Interesting, because it sounds like they aren't going to be cutting as much next year as maybe the markets were looking for. So that could be bearish for us. We got a lot of whipsawing going on. Again, this is why I tell you probably the best bet for you to do during the FOMC is to not trade it at all. Wait for the, basically the mess to settle, the dust to settle, and then go in for a trade. Because you're going to get some, back and forth. We might end up blasting off from here. Who knows? Like, I'm still in my short, but I'm not too confident on this. I could put my stop probably above this range of 93.27 on this short. That's where I would put my stop, because we get back, we go above there, it's just blast off. We're going much higher. We're going much higher if that happens. So that's why I will keep my stops really tight right now. I didn't put much on the table, only about 30,000 on the short. So, not too sure. And you're going to get a lot of false signals, especially on the Scalpalytics. I really suggest not trading Scalpalytics during FOMC. It's too many false signals. Too many false signals. So we'll monitor it. I'll, let you guys know. Powell might really, we got to listen to what he says during the speech. I hate to say that every time, but we got to listen to Powell double speak, go back and forth, make no sense to truly see which direction and what the outcome of the markets are going to be from his rhetoric. So we just got to wait until about 2:30, see what's going on, and we'll go from there. Let's do a roll call, though. In the building, we got Courtney Johnson in the house. Somebody over, give me some love over on X. Show me some love over on X. We got House of Trades in the building. AI Griff, Wisdom Bars in the house. IS Choir 45 is in the house. We got Mike P in the building. Jason Lynn's again in the house. Thank you guys for all tuning in right now. on this special FOMC live stream with yours truly, Crypto Blood. Now, again, I show you guys this is why you don't trade FOMC with Scalpalytics Pro. It's just too much back and forth. Now, you might get it, but I will wait at least 30 minutes after. I would honestly wait until Powell starts speaking, maybe like a couple of minutes into the speech, to figure out which direction we want to go, because it may whiplash back and forth all hour long. And if he says something crazy or responds in a way the market doesn't like during the Q&A, it could go the other way. It could go. So this is why I tell you not to really, if you're going to trade, you just got to scratch that itch. Make sure it's a small trading size. Nothing major. Nothing major, ladies and gents. Nothing major. Because it will go back and forth, up and down, all around, for sure. So I want to bring your attention really quickly to the fact that the prices are going up on Scalpalytics Pro, ladies and gentlemen. Make sure you guys sign up for Scalpalytics Pro before December 15th, because the prices are going from $49.99 to $79.99. And if any of you, and let me just make sure, so we do have, it looks like really quickly before I finish that, we're about to go long on Bitcoin. So I'm just going to go ahead and reverse this trade, take a small L. I think I took like $100 L on that trade, and I'm now going long. I'm now going long, guys. As you guys see, I took $155 L on that short. But I'm prepared to take another 150 on the downside too. I'm prepared. November 29th, we killed it though, ladies and gents. Look at that right there. Cha-ching on that short from November 29th. $4,700 on that trade. Listen, I'll show you guys the trades, man. I'll show y'all the Triz age. Let me see. Haven't traded this account in a while. But that's where we are. So we're now going long. Okay. Look at this wild mess right here. Just all over the place. All over the place. We got V here. We got an A here. We got a V here. We got an A here. We got a V here. What is going on? What is going on? Too much indecision, guys. This is why I tell you don't trade the FOMC. And if you have to trade, very light. Maybe a third of the amount of a position you normally would put on for these, until you really find out which direction the markets are going to go. It typically does give you a nice move once it figures it out. So I'm not saying don't participate. Just keep it light until you find out which direction we actually ultimately end up going in these trades. Took my L. Yeah, I took my L too, bro. I took the L on that. Now we're going to try to make it back. I'm not putting nothing major on the table until after Powell speaks, because I'm conflicted on which direction or really more so what the Fed is going to do. I'm really conflicted on what that FOMC meeting minutes said. So we got to wait to see Jerome Powell speak at 2:30. Hit that like button. Share this stream, ladies and gentlemen. Let's get it in. Let's make some money. And back to making money. Scalpalytics Pro increasing December 15th. So make sure you get in and grandfather your monthly subscription in at $49.99 before it jumps to $79.99. Now remember, I don't know, some of you may remember, some of you may not. We started at $24.99. Then we jumped to $44.99. Now we're about to jump to $79.99. So lock in, man. These prices are going to continue to go up. I got to stay ahead of the pace of inflation, ladies and gentlemen. I got to stay ahead of the pace of inflation. That's how fast. If they do the money print game, man, listen, prices at the grocery store are going to look like this too. Almost a doubling. So get in, lock those prices in now. Scalpalytics Pro, again, only $49.99 right now, but on December 15th, I will be jumping it up and forever going to $79.99 and beyond, because I'm sure we have to increase in another 6 months or so. Lock in that $44.99 rate right now, grandfathered in today, and you'll never pay a higher price no matter what. All right, real-time algo signals, razor sharp scalping, entries, and absolute domination over. And you can add this to more than just crypto. You can overlay this. Of course, you have to tweak the parameters, but you can overlay this system on stocks, futures, and crypto. So again, last chance, December 14th at midnight. I might bump it out to December 15th at midnight. We'll see. But bloodalytics.com, link is in the description below if you are interested in that, ladies and gentlemen. I will also put the QR code up there on the screen right now so you can scan that and lock in, get in where you fit in as well. All right. Now, I have an interesting Reddit that I came across, and I was just like, man, this is spot the F on. So this Reddit article, and we got about 15 minutes before Jerome Doublespeak Powell gets up there, but this sums it up, man. This is how I've always felt, but I never could articulate it the way that this guy did here. I don't know how to use Prabuddha Paramuna. I guess it's his name. I don't know how you pronounce that name, but man, he definitely just summed it up perfectly. So what is he saying here? And this is how I feel about quote unquote systems versus indicators. There are a lot of indicators out there for sale, right? And this Reddit here, the title of it is Why Most People Build Indicators But Never Build Systems. So algo is not a signal, it's a process. He says, after 10 years plus of building semi-automated trading strategies, I've noticed the same pattern. Most traders are obsessed with indicators. Almost none are obsessed with systems. Here's the difference and why it matters. Okay, so he goes on to break it down even further. Indicators tell you what happened. An indicator is just a transformation of price. You got ATR equals volatility, RSI, MACD, so on and so forth, right? Indicators describe conditions, but conditions don't pay you. A signal tells you something might be happening. RSI oversold, breakout, divergence, cross. That divergence, shout out to my man Default. He loves that bearish divergence. Retail, he says, treats these as entries, but a signal is only one piece of the puzzle. In isolation, signals are meaningless. A system tells you what to do next. A real trading system is a complete decision engine. I'm going to say that again. A real trading system is a complete decision engine. Signal, when something interesting occurs. Filter, when it makes sense to take it. Entry logic, exactly how and when to enter the market. Limit, retracement, confirmation candle, etc. Stop logic, boom, stop logic, and exit logic, ladies and gentlemen. Position sizing, regime logic, all these things play into and make up a trading system. And on top of all of that, you have the performance feedback. So how the system behaves over hundreds of samples. This is an algo. Everything else is just decoration. The trap, people think indicators equal strategy. It's not. No one gets funded or profitable by saying, I use MACD, I use RSI, I use VWAP, I use order blocks, I use VEI. It's like trying to build a car by buying a steering wheel. A strategy, ladies and gentlemen, is not the tool. It's the assembly of tools into a controlled process. Bada boom, bada bing. It goes on and on. I'll share this in the chat room really quickly. But when I saw this over the weekend, I was like, man, this guy hit it on the head. He hit it on the head, ladies and gents. And this is precisely the difference between an indicator and, let's say, something like Bloodalytics, Scalpalytics, where it's an actual system, because it gives you entry, it gives you stop loss areas, it gives you take profit regions, it gives you all of the necessary indicators to compose a trading system. And that's why it's, if used properly, and I tell you guys all the time with the Scalpalytics Pro, and I actually, on the chart you get with Scalpalytics Pro, what I did was updated these ranges so they're more, you get more useful information out of them. So they used to say here, like Eurozone or London zone. I changed this to average time for quality signals. And then you have the US zone is now best time for quality signals. So basically giving you an indication on when to best trade the Scalpalytics Pro system. And typically I get better results leading into the US trade session, except for days like today. Right? Days like today, throw it all out the window. Ain't gonna work for you in most cases. All right. But I thought that would be a useful Reddit post for you guys to see and understand the difference between an indicator and a whole trading system. Big difference. Big difference. So let's get over to, we got about 10 minutes left, ladies and gentlemen, until we get more information from the FOMC. Let's see what our guy here, Rick Santelli, is talking about. Not at all. Okay, you guys aren't getting any sound. Let me see. 1 second. Let's see here. Stop sharing and try this again. Let's try this again. What about now, guys?
On that. He's a strong human. He's always been a fiduciary. He's doing what he thinks is right. So I don't think he's going to bend one way or the other to make his, riding off into the sunset look better. But he's doing this for a reason, and that's where I really want to unpack and get a better understanding. Why did they do more than the 25 basis point expectation? Because in essence, they did.
All right.
Maybe they did.
Drop me a 1 if you can
Maybe
hear it
it's
now.
just a tool for, the banks have been having a hard time, Jeff. I don't know if you saw all-time highs, for the bank stocks.
I note sarcasm.
But Kelly, think about it. Every time they've cut rates with the S&P near a 2% or less high.
You wasn't missing shit anyway.
All-time high. The times they've cut it, it's been 20 times. Guess how many times a year later the market's been higher? 20 times. 100%.
And that's why we talked to Tom Lee, or a little bit earlier on, who said he said even if it's a hawkish cut, he would view that as kind of a bullish outcome or a bullish signal. So you have to imagine that this leaning more in the direction towards accommodation
seems dovish.
Even more so. Yeah. Do you do anything else now to change your thoughts prior coming into this meeting or no?
No, I think you have to really focus on this presser. We're going to see what's about to happen.
Yeah.
We're going to take a short, speaking of, let's take a very short break, folks. One small commercial break, come back, it's the final comments. Then all these questions we've just asked, maybe they get answered by those 3 flags.
Maybe they do, maybe they don't.
We're back right after this.
All right, so let's take a look back at the charts really quickly. See what's going on. Chop suey. It's chop suey, guys. It's chop suey. Again, highly recommend you do not trade during FOMC. I'm just being honest with you. I would not trade until we get a clear path and the markets digest whatever your boy Powell is going to say today. Whatever double speak he's talking, that's when after that, that's when we trade. That's when you actually want to trade. All right. Stay on the sidelines. Don't be like me. Yeah, I appreciate it, bro. Sitting there looking like I mean, you guys can't read sign language or read lips, so I appreciate that, bro. But yeah. So we're just kind of waiting around, man. We got to see what's going to happen today. Let me know what you think Fed Jerome Powell is going to, which direction do you think he's going to make the markets move? Because if you guys couldn't hear it, but the guy they just had on was talking about basically we got a QE light on the way. That's essentially what the Fed just signaled. So maybe we need to see a confirmation of that in the rhetoric from the minutes that Jerome is putting out here in about 2 minutes. So if that's the case, if he does explicitly say, look, we're starting to print a little bit more, I think we go higher short term. Now, this does not mean we are kicking off a new rally or anything like that. No, I'm not saying none of that. I'm not saying none of that at all. Okay. But we could get another move up in the markets. And if I bring up my main chart, you'll see something interesting happen. And this happened yesterday. So yesterday we did very well on the Ethereum long. I think Bitcoin as well. Scalpalytics Pro caught all of this. We caught all of this right here, ladies and gentlemen. I'll show you in a minute what I'm talking about. Let me go back here to yesterday. So here's yesterday. Bitcoin, Scalpalytics Pro. We caught all of that. Empty trade here long. Took 50% of our profits. Another 25. We took it all home, ladies and gentlemen. That was yesterday's pop on Scalpalytics. Back-to-back wins because the day before that, on Monday, we took a short and took all that money there home as well. Okay. All initiated during, as you can see, the U.S. trading zone, U.S. trading time, 9 o'clock. That's when I will start looking for signals to trade with this system. We just went over what a system is and what an indicator is. This is not an indicator. This is a system. This tells you when to get in, when to take profits, where your stop losses are, et cetera, et cetera. All right. So same thing happened with Ethereum yesterday. Boom. Right there. 50% of our profits. And then the rest up there. But I say all that to say, we have breached this downward trend line. This downward trend line we have breached. That is bullish. That is bullish. That is bullish, ladies and gentlemen. That is absolutely bullish. This line right here, we breached above it. Again, this was the move yesterday, right there. This is the move on Ethereum, Scalpalytics Pro, boom, right there. Took all those profits. And again, see, if you would have stopped trading at the end of the U.S. zone yesterday, you would not have this back and forth. You would have not lost additional, some of your, probably like half or more of your gains were taken back right here after the U.S. trading zone. So stop trading around 4 o'clock. That's what I suggest. Again, this is Bitcoin yesterday. This is the actual move that I was showing you on the other chart. This is the move where we took a long trade right here into that long and took all the money off the table into the evening of yesterday. Basically this pop right here. So this pop right here, we took all that money. So with that being said, we have run into resistance at the $94,000 Bitcoin range. And it's going to be interesting because we can break above this range of 94,000. We are going to 100K. We're going to 100K. So if he is telling us QE is on, we definitely could get back to 100K, ladies and gentlemen. I'm just saying, let's get back over to Jerome Powell. See what he's talking about right now. Let's go.
Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated.
Yes, sir. Thank you.
In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Oh my God.
At the Fed, we will do everything we can to achieve our maximum employment and price stability goals.
Freaking
Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and
that was a canned response. That's so crazy.
Given rise to that, is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending is held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year. because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down? Or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year, but when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation. And as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation. But we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both showed declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew. Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
No, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2000 and was it 19 where we cut 3 times, but this is such a unique situation. It's not. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward. Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Mike.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about affordability, the affordability issue. And so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages, so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember, when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that's exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing. and it will be corrected. I don't have the exact month in my head right now, but and that's just I think forecasters generally understand that. So, and we think it's about 60,000 a month. So 40,000 jobs could be negative.
Scalpalytics Pro still on that long from Bitcoin. We're breaking out to the upside now. Up about $300 on this Bitcoin long trade right now. Scalpalytics Pro, bloodalytics.com. Check it out. Check it out.
But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much. So it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen.
Not this time,
What will happen here, we're going to have to see. But right now is such early days. We don't think we see much.
We're moving, ladies and gents. We're moving. We're moving. We're moving.
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied on in each group as well. There's some of that, but I would say they're also governors and
exactly.
and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
What a great answer, Powell.
Christine.
What a great answer. All those PhDs.
Thank you, Chair Powell. Christine Romans, NBC News. Wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that asset values, housing values, and securities values are high.
Breakout occurring right now. Scalpalytics Pro. We're long on Bitcoin, ladies and gents. We're making that money. We're making that money. Let's go. Let's check on our trade. Up about Almost 500 bucks on this long on Bitcoin. We took an L for 155 on the short earlier, but stayed with it, went long. And now we're up about 500 right now, ladies and gents. Let's go. Bloodalytics.com.
Years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris. Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having, social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Breaking news, Fed Chair Jay Powell following the committee's decision to cut interest rates by 25 basis points.
Nothing from Jerome Powell. A whole hour and 24 minutes. And clearly something was said that the market's like, because we are off to the races and probably just wanted to wait until he was completely done to fully digest what's going on. We'll see. But as you guys can see here on the screen, we did break out above this zone right here. Okay, that was a nice area. Now, we did not get above that area right there, though. We need to see a breakout above there for a new move up. Now, slight rejection. Now, this is on the 1 minute, so we can't give it too much credence. But we did get a slam down right at that zone. Let's see if it'll try another attempt at going higher and maybe burst through that area of 94,000. If we are able to do that, again, we'll see what things look like tomorrow. If we see a continuation or another rejection at the $94,000 range you see here on the screen, right in this zone, right? If we are able to break through, I have to say 98,000 is the next target. $99,000 Bitcoin, maybe a pause at 96. We could get a pause there and move back down to the 93 zone. But ultimately, I'm thinking that if we break above this 95 range or 94,500 range, our next target is going to be $93,000 Bitcoin. Okay. And, we'll have to see, man. If QE is back on deck, ladies and gents, it will change some things for us in the short run. Michael Saylor might be saved from going back to McDonald's. He just might. But ultimately, I think he is going to be the catalyst for Bitcoin getting really, really hammered. We have 20 days left. I don't see us getting to all-time highs. Even if the market digests this news today as QE light incoming, it's just not enough. The market is so reliant on the Federal Reserve drug pump, that drug dosage, that it needs full-on QE like we saw in the pandemic, something like that or more, for us to really move the needle. And I don't think we're going to get that. If we get that, it's going to be at much lower prices, at which in the equities market, at which we could see a pump from there. But we would have to go much lower in equities for us to see some type of emergency injection of cash into the system. So it kind of balances out. Now, my guy Jason Lenz asked me about the, what do you call those companies? The prop trading firm. It was called Bitfunded. I stopped trading there because I was unsure about their policy. It seemed that you look at the verbiage, it looks like you don't get real cash when you get to the final stage. And now I was a little, it looks like they've changed their website. See, this is where I have a problem. It's time to claim your withdrawal. Earn payouts based on your simulated profits with an 80-20 split. After reaching your profit split day, your payout is processed within 24 hours. What does that mean? Simulated profits. I don't know, man. I was a little skeptical on that. Anybody else know of a prop trading firm that Jason Lenz can use? Let us know in the comment section below or in the chat room right now, because we'll take a look at it and we'll map Scalpalytics Pro to it. But I'm not too sure. I stopped trading it. Just shy of stage 2, actually. So I don't know, man. And the person, the rep that I was dealing with, kind of gave me a weird, he said, yeah, it's real money. But I said, look at your website. Why aren't we, why do you have on there that, it's simulated profits? Not sure about that. Trade Intuition in the building. What's going on, bro? Should have had you come on for the live stream. High Road Trader for crypto. Trench Trench Juice says. All right, we gotta check that one out, Trench. We'll definitely check that one out. High roll trader. Have you seen success with that one? And are they really doing payouts? Let us know. That's right, man. Hit that like button, ladies and gents. We got like almost 3,500 people over on X right now watching us. Thank you for all the views. Yeah, it was bit funded. Yeah, that's it. Thank you for all the views. Hit that like button. Follow me on X, by the way. If you're watching over on X, follow me on YouTube. We'll be doing live streams every morning, 11 a.m. Eastern Standard Time. Maybe there will be some trades we can do live. I'll try to, always try to give you guys the setups when live, but I typically trade during the 9 a.m., 8:30, 9 o'clock. I'm trading my account live, not live, but I'm trading my account. I go live at 11. So if there's anything else left to trade, we'll definitely try to put those trades on there. But I had to stop trading at 9 live because I was giving away too many trading profits for free. Trench said, I'm not a fan of props for crypto in general, as crypto is too volatile for prop style rules, but they're the best for sure. All right, man. Look, appreciate all the alpha that my viewers are dropping. D breakout prop is lit and pays. Okay. We got to check that one out, Jason Lenz. Breakout prop. Is that the same as D breakout? Maybe K meant breakout prop. David Digital in the building. Oh, breakout prop. All right. Breakout prop. David Digital and K, the GOAT, is saying are good too, Jason Lenz. We got to check those out. I'm going to check that. I'm going to check into that one too. But what Jason Lenz is, why he's inquiring, because he's a Bloodalytics member, Scalpalytics Pro member. He's using that on his own funds, on his own account, and making mad money. So can you as well. Bloodalytics.com, Scalpalytics Pro for Bitcoin and Ethereum. We got, I think, BNB and XRP, or SUI and XRP and BNB and Solana. Check them out, Bloodalytics.com. Prices are going up on December 15th. From $44.99 to $79.99, and it was increased from $49 or from $24.99 to $44.99 about 6 months ago. So the increases are going to continue. Check it out. Lock in, grandfather your monthly subscription in ASAP, so you get locked and loaded, and it protects you from the increase. All right, we got to blame Federal Reserve Jerome Powell for the increases on Bloodalytics.com, baby. All right, ladies and gents, I'll continue to monitor this along. We were up about 500 earlier. I personally think we might go higher because I'm seeing some support at this last high, but we'll see. Nothing's promised. We can see a smash down at the end of the day. We got about 350. You could see a smash down, options expire and all that stuff. We'll see what happens. All right. Scan that QR code for Bloodalytics, the Scalpalytics Pro signal. Again, at the beginning of the stream, I told you guys, I broke it down. The difference between, this is not what I've built here at Bloodalytics is not an indicator. There are a lot of indicators out there. We know of them, but this is not an indicator. And I went over this. I'll share this again in the chat room so you can see and understand exactly the difference, because there are huge differences between indicators and complete signals or systems. Or I could blame the tariffs. Of course. Gotta blame the Trump tariffs, man, on the digital subscriptions, right? Gotta blame the Trump tariffs for sure. But check that link out. I put in the chat room. I'll put it over on X as well, real quick. I saw this over the weekend and said, man, this was an excellent write-up on Reddit by this gentleman. He broke it down, the difference between a system and an indicator, and it was spot on. Systems guys it's a complete decision engine. It gives you the signal where something interesting occurs. It gives you the filter when it makes sense to take a trade. It gives you well, that's kind of like the filter is the entry logic too. It gives you the stop logic and exit logic. Those three things pretty much, that's the meat and potatoes right there, ladies and gents, on the difference between a strategy and a signal. And you'll do better with a whole system, not an indicator. It gives you a better indication of how profitable something is if you have all of that included in your trading regime. That's it, though, ladies and gents. I appreciate each and every one of you. Make sure you hit the like button, share the stream, and come join the Bloodalytics team right now. It's your boy Crypto Blood. I'm out of here, people.
Yo, it's Crypto Blood, Detroit flow, screaming from the D, knowing what to show. Indicators are wrong point, OG since 12, invested in trade, living life like a pro. I'm Rucker, Jerry, and just Bloods do. Bad motherfucker in a good way, boo. Got my eyes on the charts, ain't no time to sleep. Get that money, gotta keep it creep. That's why Crypto Blood, just the toasters on the line. Stacking my coin, got the market on my mind. Bitcoin, Litecoin, Ethereum too. Cash is king, but I'm looking for a new move. I know the culture of the markets, like the streets. Got my finger on the pulse, can't nobody beat. I see the trends, I see the flow. Got my strategies in place, you know.
Stacking my coin, stacking my coin, stacking my coin, stacking my coin, Bitcoin, Litecoin, Ethereum, cash, Bitcoin, Litecoin, Ethereum, cash, stacking my coin, stacking my coin, stacking my coin, stacking my coin, Bitcoin, Litecoin, Ethereum, cash, Bitcoin, Litecoin, Ethereum, cash. Since I was born, been stacking my coin. These niggas pop, my money keep growing. Your girl is a dot, she all on my groin. She blowing my horn, we fuck like porn. These rappers is whack, they lyrics is corn. I'm getting this money, it never get born. I'm loading my trap, they calling law. Fuck around and you clap, for running your jaw. If it ain't about the dollars, then it don't make sense. Got me sipping brown water, but it ain't from Flint. Trying to chase all this bread, though the shit won't last. About to shut the city down like a crypto crash.
Do it live! I'll write it and we'll do it live!
Okay. Ready?
Fucking thing sucks. We'll do it live. Okay.